The
Yeah.
second biggest breakout of all time is going to be silver breaking out through $50 an ounce, because that is going to be a what 46 year or 45-year long breakout.
The Financial Survival Network. Now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, after a couple of solid weeks of metals inching and sometimes going more than inches ever higher, we finally get the pullback day, which we were expecting. No surprises there. It's September 17th. Gold's down about $30 the ounce on spot, and silver is down about $1.15. Well, someone who follows this stuff for a living and has been since I knew him, Jordan Roy-Byrne, is with us now, thedailygold.com. Jordan, we've been having this conversation now for over a decade, but finally this conversation has evolved. It's a different conversation than we had 2 years ago, isn't it?
Yeah, absolutely, Kerry. And it's great to be back with you and your audience. And yeah, I mean, it's completely different now because last March of 2024, gold finally broke out of the cup and handle pattern. It broke out of a 13-year cup and handle pattern. And I talk about this on in my new book, which I published earlier this year. And I'm scratching my own back here, but people can get that for free if they go to thedailygold.com. That's why I'm referencing that. And that breakout was one of several signs setting the stage. We're really confirming that we have begun a new secular bull market in gold. Another thing which I just started tracking in the last couple of years is gold against the 60-40 portfolio. So that's the conventional investment portfolio that everyone knows, 60% stocks, 40% bonds. Gold broke out against that portfolio of a 10-year long base in March of this year. And so that tells us, I mean, we got the breakout in gold in nominal terms a year ago. Several months ago, gold broke out against a conventional investment portfolio. That tells us, Kerry, that capital is starting to move from conventional areas into gold. And by the way, in the last couple of weeks, we actually saw GDX and the XAU, amongst other indices, broke out of a 11-year long base against a 60-40 portfolio. So that tells us capital's moving away from conventional into actually miners. And what'll be coming up next will be silver breaking out of an 11-year long base against a 60-40 portfolio. So we are in a new secular bull market. This is one that is going to run for probably at least a decade. There's many reasons for that. This is not just a thing that's going to pop for a year or two. We're in a new secular bull that's going to run into at least, I think, the mid 2030s. We're in the first cyclical bull market within that longer term secular bull market. And yeah, I mean, we are finally where we all were thinking we were going to go. And we are there now. And it's been really exciting the last 12 to 18 months. Short term, medium term, it looks like we're at some kind of a peak here, especially in the miners. Maybe gold and silver will follow. I think eventually they will. So people do not get dissuaded by the weakness that we might see over the next few months in the fall. This is much needed. This happens in really strong bull markets. And Kerry, whether this correction lasts, 3 months, 6 months, 8 months, 2 months, whatever. What's really interesting is some of the absolute biggest moves in gold and silver, they come after gold makes a breakout, makes a big move. Then it comes back in bottoms around the 200-day moving average. So it's happened 6 or 7 times in its history, in gold's history. And so when it comes back and tests the 200-day moving average, from that point forward, it has made absolutely huge moves in these secular bull markets. So that is something I'm looking for. Again, I don't know if it'll be in 2 or 3 months or 6 months, but looking out over the next 12 to 18 months, we're probably going to see a period of weakness and correction first. But after that, we're going to see another big leg higher, because everything we're looking at, technically, fundamentally, it's all in line. We're just too overbought right now, and the market's got to rest because, it doesn't go straight up.
Yeah, the tree does not grow to the sky. And, one of the things I like about you, Jordan, is you're not out there saying gold's going up all the time. You've been cautious for years now, and you have not been one of the people overhyping it, but, pointing to the long-term trend that It's certainly higher. It's going to happen at some point, but you never, you are not a raging bull until very recently. And I think that's something important to note here. So now you've come around. I have a feeling that this correction goes shorter for the simple reason we're in the seasonal uh, positive. The generally gold, silver go higher in the fourth quarter. So maybe it'll act to frustrate us, but most of the time, gold is going to make new highs during this time of the year, the fourth quarter, Q4, beginning of Q1. So this, maybe it'll stay choppy till the end of the year or till the beginning of December. But at some point, I think it's going to break out this quarter, coming quarter.
Well, I would say with corrections, typically corrections, of course, they could all be different, but generally, you have price and time. So you typically get either the correction consolidates and it goes sideways for a period of time.
Mhm.
But the other scenario is you get it in terms of price where you get a sharp leg down, but it doesn't last that long. So what you're saying, that would fit that style of correction where you get a sharp leg lower, but it happens really quickly and people are like, oh shit, this thing's going to crash. But then the buyers come back in and they push it all the way back up.
Yeah.
So that is and I'm not sure which way gold will correct, but generally corrections tend to follow, especially gold, one of those two scenarios.
Yep. Yep. And I think it'll be rather short lived. That's just my feeling because the coiled spring of silver, we're talking 60 years of suppression. Yeah, they can only manipulate the market in the short term, but if they keep manipulating it in the short term, at some point it turns into the long term. And I think that's where we're at now. I think the fact that the government is contemplating putting silver on the critical minerals list was that final catalyst is that it needed. It was already going up. Everyone knew it. But then all of a sudden the government saying the obvious really kind of put it over the finish line.
Well, I just did an interview with Vince Lancy, and he actually mentioned that. He mentioned lithium, and I forget the other metal. I think it was uranium.
Potash, copper.
I think it was lithium and uranium. He said, like, when they put those two on the critical minerals list, like if you look at if silver made the move, those two metals made or minerals made, I think one puts it at 80, the other puts it at $140 an ounce. So I'll just say this, Kerry. I'm a technical analyst.
Mm-hmm.
The greatest breakout of all time in capital markets history was commodity prices, or really gold, in 1972, because you actually had to go back to the Civil War. So gold was breaking out of a over 100-year-long base, and of course we know that the gold standard, it was artificially suppressed, especially in the 1960s. People were buying gold stocks. They made a fabulous move in the 1960s, even before the 1970s. So that breakout in gold was over an over 100-year-long technical base, something that had tested multiple times. I mean, that's a lifetime. I mean, more than a lifetime for most people.
Yeah.
The second biggest breakout of all time is going to be silver breaking out through $50 an ounce, because that is going to be a 46-year or 45-year long breakout when it surpasses $50 an ounce. So a lot of the hyperbole that people have been talking about with respect to silver in recent years, it hasn't made a lot of sense, but we're really close to the point where, these targets are, 100, 200, 300, these targets are going to start to come into the present, that they're going to sound less and less ridiculous, because again, we are at that point where we're so close. And when silver breaks above $50 an ounce, Kerry, again, this is the second biggest breakout of all time. It's a really long time. The biggest breakout since 1972, again, when gold broke out of a 110-year-long base, I think. So this is a super exciting time for silver. And, just looking at the short term, 43, 44, wherever we are right now, this is the last resistance from here, between here and now, and $50 an ounce. And I would also let's look at the quarterly close that's coming up in about 2 weeks here. So that'll be significant. There's a chance that silver could close at a new quarterly all-time high. So that's significant because when gold actually made its quarterly breakout, that was in, I believe, December of 2023. So that happened several months before it did it on in daily and weekly terms. So if silver, I believe that the quarterly all-time high is 38 maybe, or 37 something. I could be wrong. Maybe it's 38 change.
I think you're
So if
right around it. Yeah.
yeah, so if we see silver close above that in 2 weeks, the new quarterly all-time high, that basically tells us it's going to break 50 sooner rather than later. And so, and here's another point about that breakout, Kerry. I looked at what did copper and oil do? They broke out of in the mid 2000s when they broke out of multi-decade long bases. Oil broke out above 40, made a huge move higher. Copper, I believe, when it broke above, what is it, $1.50 or $2? You can look at the chart. That
Correct.
thing exploded in 12 or 15 months. So if you take the moves that oil and copper made after those long breakouts and project it onto silver, which is breaking out from an even bigger base, silver could go to $100 in 12 or 18 months after it breaks out. So, and that's not hyperbole. That's analysis, looking at history, looking at what happened with these other markets. So, yeah, I mean, so we're setting up. I mean, it's going to be really, really explosive in silver, and we're not quite there yet, but we're damn close.
And we knew it was coming. You know, I talked with you, David Morgan, a bunch of other people, and, you know, there was no question it was coming. It's been building to this, and it's a 60-year coiled spring. Yeah, I mean, look, back in the 60s, silver was trading for $1, $2 an ounce once upon a time. But then in 65, which was a momentous year, they demonetized silver. And Jordan, you know, and I know that most of the people alive on the planet today don't remember when silver was money. So they're going to get a major education in that fact very, very quickly. Just a couple other points. Few months ago, I'm at Rick Rule's conference. I'm talking to a metals dealer and saying, you know, I really like these 40% Kennedy half dollars and Ike dollars. And he's, oh, they're garbage or this and that. I said, yeah, but they're garbage. But I bought them back when silver was $8 an ounce. And that was back in 2010 after the crash, when it brought gold and silver prices down. And now, you know, the things are worth, back then it was like about 32 an ounce. So they've quadrupled from their face value. And I bought them below spot. All right. I bought them below melt value. And up until 3-4 weeks ago, you could still buy them below melt. And that was like the last bargain. The other thing was war nickels, 35% silver from back in World War II. They're still around. I bought, like, you know, I didn't buy tons of the stuff, but, you know, a couple $1,000 worth, because I just knew I'm buying silver for below what its melt value is. I don't care if the smelters don't like it because it takes more work and energy, right? And now all of that is going to be at above spot. You can't touch those 40% and 35% coins for below spot anymore. They're trading over spot, over melt. So that to me is like the most satisfying thing, because the so-called pros have avoided it. But when there's a shortage, they'll take any silver they can get, right?
Yeah, and I love your story there about the trader investment. Well, I guess it's an investment because you're not selling, but it goes to show you how with age and experience comes wisdom. And so whether it's yourself or Rick Rule and other people, they know what's going to happen. You know, they've been in this a really long time. We know what the monetary history is. And so if anybody out there is concerned about what's happening the next month or the next quarter or the next year, we know where this thing is going. There will be volatility along the way, Kerry, but we're in the next decade, we're headed to some kind of a new gold or monetary system where gold probably has to be reintroduced as money. There's no other way. If you look at, again, you look at a 200-year chart of gold, you can see what is going to happen. This thing is going parabolic. There's no way it's going to stop. It'll be reintroduced as money at some point. That's the only way. They can't raise interest rates. And this is another really important point, Kerry, which I don't think most people have mentioned, but I talk about this in my book. What has really driven gold recently in the past few years? It's been a combination of central bank buying, but also the new secular bear market in bonds. So if you look at the total real return of bonds and you use an 80-month moving average, you look at this data going back 100 years, falling below this moving average has marked the start of secular bear markets in bonds. This happened in 1965 or so, and it also happened after the low in COVID, so 2021 or so. Kerry, you think about the period from 1920 to 2020.
Mm-hmm.
You made money in bonds other than from the mid 60s to the early 80s. So we are in that period again where we're in a secular bear market in bonds. And this is very rare. Again, it only happened in that 100-year period for about 15 to 18 years. So most people do not understand the reality of what that entails.
Absolutely.
It has huge impacts on society, for the economy, eventually the stock market, but also for precious metals. The 1970s, why was that such a much greater bull market than in the 2000s? Because you had a secular bear in bonds, but you also had a secular bear in stocks. We're not there yet. We will get there at some point in the next couple of years. When we get into a secular bear in stocks, that's when precious metals, that's when you're going to see asinine levels. But my point is, that's what drove the 1970s. The three major asset classes. You have gold, hard assets, stocks, and bonds. You had stocks and bonds in a secular bear, right? We've already seen bonds fall into a secular bear. Stocks are still in a secular bull, but eventually the bond bear market is going to inflict stocks as it did in the late 60s and early 70s. And so we haven't even reached that point yet. So that just should tell people that this thing has a long way to go. We are only in the early days now, and that silver at these levels, it's going to be hundreds of dollars an ounce in the next, 3, 5, 6 years, something like that. And gold will be, gold's going to be closer to 10,000 at that point. So the technical setup is there. And if you look at history, you look at 150 years of data and see where gold and silver peaked. Where were they relative to the S&P or the Dow? Where were they relative to the monetary base? You look at some other data series like that. They all tell you, gold's going to 20,000 basically, just based on history. And if you look at every peak in precious metals, the gold-silver ratio, where did it bottom? It was around 15 or 16. What does that tell you where silver is going? It doesn't mean silver's going to stay there or it'll be there forever, but that tells you ultimately where the metals are going over the next 5 to 10 years. And so we're in a really exciting spot, and it just started in the last year, so it's still early for people to get in. So just buy a little bit of metals every month. Just buy a little bit and just keep stacking.
That's what I do. I basically haven't really bought anything meaningful since 2011, a little bit here and there, just to prove that I could buy things under melt value. It makes no sense that you should ever be able to buy under melt, because it just shouldn't be. It's an anomaly. And then the gold-silver ratio, when you're looking at 108, come on. It cannot stay there, because even whether the government says it's a critical mineral or not, doesn't matter. Everybody knows it is. So this is just the government admitting and extending tax benefits, expedited permitting to silver projects. There's a lot of silver projects out there that have just been sitting around, especially in Nevada, just waiting for that right catalyst. Hey, what about the cost, the economics of mining now? Pure silver, because we don't have many pure silver miners. What happens to that?
Well, right now, oil is obviously energy is a huge driver of inflation, and that's been kept low. It hasn't been increasing. Of course, costs are going up a little bit every year, and I mean, general inflation
Yeah.
is very significant. But with respect to the energy costs in mining, it's so significant. And because it hasn't been rising really at all in the last few years, that's why mining companies right now, their margins are just spectacular. Like Kerry, these companies, whether it's a producer or an explorer or a developer, they don't even need margins to change. Like these prices and this level of prices and costs, they don't need margins to go up. They can make tons of money. These stocks can balloon to the upside in the next couple of years, even if margins just stay where they are, let alone what happens if margins keep rising, which I think will happen eventually and anyway. And so, yeah, there's going to be a massive bubble and mania coming in these stocks. I mean, based on that, they're still cheap now. But circling back to the cost of mining, one thing I talk about in my book, which I discovered, if you look at the Barron's Gold Mining Index going back 100 years, and you look at gold divided by the CPI, the inflation-adjusted price of gold, that's actually a great indicator for how gold stocks perform over the very long term. And it makes sense because these companies, they move based on their margins. It's not based on the gold price or the silver price. Yes, that is a massive input, but ultimately it's their margins. Gold and silver divided by costs or minus costs, where that reflects how the stocks are going to move over the long term. And again, so you look at gold divided by the CPI or silver divided by the CPI, and you line that up with GDX, SIL, et cetera. They over a long period of time they track really, really closely. And so gold, using in monthly terms, gold against the CPI in monthly terms. I know in daily terms, I think it just broke out to a new all-time high. But in monthly terms, this thing broke out of a 45-year-long base in recent months. So that kind of breakout has huge implications over the next 2, 3, 5 years. So I do think the cost of mining will continue to rise and creep higher. And, at some point they'll rise too much and faster than the metals. But for here and now, I still think that in real terms, you're going to see gold and silver prices just continue to rise. And that's going to incentivize, obviously, a lot of new production. And I'm glad that we're, the permitting and all of that in the U.S. is getting streamlined. And one thing I'll note, Kerry, is silver and gold, they don't trade. They trade on monetary factors. So supply really doesn't matter. I know a lot of people, they like the silver supply angle, and I get that. But if you look at the history, silver, it's like a beta play on gold. So precious metals, detractors will say, oh, prices will go up and you'll get tons of new supply. Not necessarily. We'll get new supply, but we're not, people don't invest in gold and silver based on supply and demand. They buy for monetary reasons. So, production rising and supply rising, that it really isn't going to dent this bull market.
All right. Well, that's what we like to hear. And I'm with you. I think it's going to happen. It is happening, and we'll be staying in touch because it's exciting. Look, Eric Sprott, whatever you think, the guy said $300 an ounce for silver a couple of years ago, and nothing I've seen, nothing you've mentioned makes me believe it'll be anything less than that. Because when these things move, the coiled spring, it's been suppressed. I have this little satire I do, like Trump GPT, and I have COMEX GPT, and it's the AI that they use at COMEX, and it's been having meltdowns because nothing is working. Spoofed bids don't work, and naked shorting, switching contracts. Now you'll see what COMEX is going to do. They'll start raising margins again. But unlike prior efforts to cap the price, this is going to really make a difference here.
It's a much stronger bull market this time around.
For sure. So, hey, Jordan, just tell us where we find you, how we subscribe to your August publication.
Go to thedailygold.com. You can subscribe there. Also at the top, you can get my book there for free, a PDF and EPUB copy. So I would if you're not familiar with my work, read the book first. There's a lot in there. It contains all my thoughts on everything precious metals.
All right, you got it. Thanks, Jordan. We'll talk to you again soon. Questions, comments, kl@kerrylutz.com. Make sure you go to my new website, Substack. I'll be sending out a notification about it. I've given up the conventional website because, frankly, this is a lot less work. It's a lot more effective to stay in touch with you because I'm no longer worrying about other people's platforms. I have my entire audience is there, locked and loaded. Jordan, really appreciate it. Talk to you soon and enjoy the bull run.
Thank you, Kerry.